Okay, once again, thank you all for joining us today for an insightful conversation with Geneva Financial CEO Aaron VanTrojen. Aaron has been named a top 100 CEO in America the past 2 years in a row, alongside CEOs from Microsoft, Uber, and Adobe. And today we're going to be talking about some industry topics, including compensation and when the market shifts, what some companies are doing in order to increase production, to retain their employees, and what that means. So we're going to get this kicked off. Again, if you have questions, throw those in the Q&A, and we'll be monitoring those and asking Aaron those questions as you drop them in. Aaron, I'd like to kick it off with a question on compensation and what the difference is between, I'm just going to throw a number out there, 250 basis points at, let's say, a broker, and 250 basis points at Geneva Financial.
All right, that's a hell of a place to jump in, but I'll start there, and then I'm going to probably go on a number of tangents. I do appreciate everybody's attendance, and I do welcome questions, feedbacks, opinions. I'm likely going to say a lot of things today that you're unaware of or goes counter to things that you believe, which is good. I do want to challenge you. At the same time, I want this to be educational, not all about me and Geneva. The end all goal is to give you some vast differences between wholesale, retail, and Geneva. We like to lump them all together, all brokers the same, all retail the same. They're not, and I'm aware of that. I can be accused of making blanketed statements, which I understand. If I make a statement toward retail or wholesale, it doesn't necessarily apply to all people and all company, but I make those statements because in my past history, it's been the majority. So I'll apologize in advance if I make a statement that's not properly reflective of you individually. But we'll kick it off with what James said, and then I'm going to take you down a little bit of a history. The one thing that's really, really important that the industry at large seems to really lack knowledge about is the vast differences between gross and net. I know it seems very elementary, but the vast majority of people that I talk to from coast to coast, regardless of channels, really struggle with those two things. Brokers, again, none of this is an attack on a particular channel, but brokers have been big and loud about how much they pay. And they've led most loan officers to believe that they pay more than anybody else. That is complete fiction. And it has been fiction since day one. What brokers do is they work on gross numbers, gross. And retail can also be guilty of this, and I'll get into that in a minute. But when you see a particular wholesale or brokerage company talking about compensation, it is always gross numbers. One of the biggest mortgage companies, mortgage brokerages in the country will say we pay you as much as 275 basis points, which anybody that has any knowledge about how this business works knows that's an impossibility. One, through the broker channels, due to federal regulation, the maximum amount of compensation a broker company can earn is 275 basis points, which is gross. So that's the maximum amount of money that can actually come into the company. To the company, not to the originator, to the company. So obviously a mortgage company or brokerage couldn't pay any originator 275 basis points because they would be losing money, because there's things such as, technology that needs to be paid, credit reports that need to be paid, employer taxes that need paid, so on and so forth. So that's why that's a gross number. And to James's point, if a company, to keep it simple, keep the math simple, is stating that they're going to pay you 250 basis points from a brokerage, that's gross. And after you deduct such things as payroll taxes, which are the employer payroll taxes, which are typically about 10% of the commissions, that's a fairly hefty number. Credit reports, they might charge you back for VODs, VODs, technology fees, marketing fees, brokerage fees, processing fees, the list goes on and on and on and on. And you'll find that most mortgage brokers have 100+ basis points in expenses that are going to be tacked on to that gross compensation. So They don't pay the most. They've never paid the most, but they may pay the most gross. But at the end of the day, gross doesn't matter. It's what you net. So that's very, very important for everybody to understand the vast distinct differences between, a mortgage banker and a mortgage broker. As brokers typically tend to speak in gross terms, bankers will talk in net terms. So Geneva Financial started, when we started 16 years ago, I paid everybody 250 basis points. That was net, which is considerably higher than 250 basis points gross. And again, it's going to vary company to company just how many expenses they hit the actual loan officer for, and how much that 250 or 220 or whatever the starting point is for the compensations diminished down to on a broker channel. So that's critically important, because I have conversations with brokers all the time that say, hey, you can't pay me any more than I'm making right now because I make 250 basis points. They don't. None of them do. Okay. It's a gross number versus a net number. And it's critical that you understand that through the course of this conversation. But let's talk real briefly. And again, James, make sure you interrupt me if people are asking questions. Let's take you through some real quick history of how we got here. For those of you that have been in the industry as long as I have, which is over 20 years, and survived the mortgage meltdown in 2008, well, we saw a big shift in our industry because mortgage brokers did have a lion's share of the volume prior to 2008. That changed in 2008, mostly because people didn't understand the laws that were coming. And mortgage bankers were really, really good at scaring brokers to think that the new laws that were going to be passed would take them out of business. Not true. Okay. All the laws that did pass, most of them didn't negatively affect the broker at all, with some exceptions. And none of those loans or none of those program or laws have changed since 2008 that would have sparked the resurgence that we've seen of recent. I'll get to that question that just popped up in just a minute. So literally nothing's happened between 2008 and 2023 that would cause a resurgence of loan officers into the wholesale channels, except for one thing, and that's price points. That's price point. So you saw them greatly diminish in 2008, stay diminished over the course of many, many, many years, maybe a slight resurgence over time as people started to realize that the laws weren't really terrible for brokers. With the one exception is the 275 basis points cap on the company. I started Geneva Financial in 2007, late 2007, for two reasons. I didn't want to be a broker because it's unsustainable. It's unscalable. You just can't make enough money to grow a legitimate business and be able to pay the loan officers what I believe that they should get paid. And I wouldn't go work for a retail company because in 2007, 2008, there was a great contraction on compensation paid to loan officers, which has never come back. And I wasn't going to work for another mortgage bank that was going to pay me less than I believed my worth was. So I started Geneva Financial to accommodate me as a high producing originator. And we started the company so the company would make a very small amount. In fact, and I'm very transparent, we designed the company to try to net 50 basis points and pay everything else, all the compensation to the originators and branch managers, which we've done for 16 years and actually never changed that model. Okay, so how do we get to where we're at right now? We saw a big resurgence of the brokers in 2018. Why? It's because we experienced margin compression. Volume fell off, and despite every originator that I've ever talked to that says, hey, I don't sell price, they do. In fact, the vast majority of the industry does, which is why we saw a big move away from retail into the wholesale channels in 2018. We saw them move back into the retail channels in 2020 and 2021. Why? Because price became less of an issue and business came flowing in at remarkable levels that we've never seen before. And then we saw the biggest return to the wholesale channels in 2022. Again, why? Why did we see that? Well, volume fell way off. And again, all the loan officers out there that don't sell price actually had to run to the channels where they could at least think they would have the lowest price point to the consumer, because that's most of the originators that you're up against. That's the only value that they bring to the table. Again, that may not apply to you. So I don't know any of you guys personally. So I'm not saying that you on this call are actually that person that just sells price, but the overwhelming majority of the industry does sell price, which is why you saw the resurgence. Now, here's the problem. And I think that it sums it all up. Listen, everybody that's been in this industry for the last few years understands there's this big pitch that brokers are better. It's a coined phrase. It was a model, and it was hugely effective. Brokers are better. Well, why were brokers better? Why was that such a big pitch over the last few years? Price. But it wasn't actually true. It was never actually true. The price point to the consumer wasn't lower, technically, from wholesale channels. Yes, I know there's exceptions to the rule. And in fact, 2022, we saw that they may have had just a slight advantage when the largest wholesaler in the country, in fact, the largest lender in the country, was doing loans at a net loss to the company. I can name names. United Wholesale Mortgage strategically and potentially brilliantly bought market share by funding every single loan it did in 2022 at a net loss. I mean, in the fourth quarter, I just wrote this down, the fourth quarter of 2022, United Wholesale Mortgage lost $62 million. In the first quarter of 2023, lost another almost $140 million. Well, one thing I can tell you, that's not sustainable. But they did it strategically to bring people over that could only sell price, which was the majority of the industry. Okay. Well, things have changed because you can't hemorrhage $138,000 or $138 million every single quarter and stay in business. So the biggest companies out there, including retail channels, are now increasing their margins to stop the bleeding. This is simple math. Hopefully everybody's following along. And what I was trying to get to, the loudest voices of brokers are better. One, the biggest mortgage broker in the country has started a retail channel. Why? Why would you ever start a retail channel if you believe brokers are better? And the loudest voice, and the person that started the new broker association, started a company recently that is retail. It's not a broker at all. So the only reason that I'm telling you this is the loudest voices in the brokers are better chat is they're retail or headed retail. So that should make you question why that is. And I can tell you why that is. It's unscalable. There's just simply mathematically not enough money in the wholesale channel. With the cap to the company at 275 basis points gross, you cannot build teams, you cannot build branches, and you cannot pay loan officers a high compensation working with just 275 basis points. And a lot of you might be scratching your head like 275 basis points sounds like a lot. It's not when you take all the expenses associated with running a legitimate mortgage company. It's just not. And it also goes back to, what do you think you're worth as an originator? And probably that's the most pressing point. What do you think you're worth as an originator? Just because you're offering a lower price to the consumer doesn't make you better. In fact, most people offer the price that they do and earn the compensation that they earn is because that's the only value that they bring to the table. Okay, let's not get too far off. So one of the biggest problems and challenges that wholesale has and retail has against wholesale, or at least has had for like maybe the last 18 months in particular, because that's when it became most apparent, And you heard people always say that the wholesale, has a lower price and they have better rates to the consumer. Again, not necessarily true, not necessarily an accurate statement. Brokers have the ability to do lender paid or borrower paid. That doesn't exist in a banking model, only in a broker channel. And on a broker channel, if you choose to go lender paid, it has to stay static on all your transactions. You set that up with the particular company. And so for the sake of this conversation, let's say you set up your lender paid comp with United Wholesale Mortgage at 275 basis points. Well, if you go to your borrower and offer them that rate from United Wholesale Mortgage, and it's got lender paid comp, meaning all the compensation's coming from the lender at 275 gross, and you get into a competitive situation, or you have a sophisticated borrower and you don't think they're going to buy off on a rate that pays 275 basis points from the lender, you can flip that to a borrower paid transaction and lower the comp. All the fees are charged to the consumer. So you can go from 275 generated gross income to whatever you choose, right? You can pick whatever you want as long as you're paying it to the consumer. But, and this is for instance, an example, if whatever company you're working for as a broker, if you're getting paid 250, let's just say 200, just keep the math simple, 200 basis points gross from your brokerage, whether you go lender paid at 275, so 75 goes to the company. I hope everybody's following along with the math, but then you flip it over to a borrower paid transaction for whatever reason. And let's say on that borrower paid transaction, you only charge the borrower 150 basis points. Maybe it's competitive, maybe they're sophisticated, maybe they're friends. Regardless of the reason, by federal law, your personal comp can't change. Can't change. It can't change. If you're working for a mortgage brokerage, if your comp's set at 200 basis points, they're paying you 200 basis points, whether it's lender paid or borrower paid. They're paying you 200 basis points, whether it's lender paid or borrower paid, even if the borrower paid is generating less income than 200 basis points. If they change your comp, if your company or if you're a company owner and you change your comp based on whether it's lender paid or borrower paid, you've violated a federal law. I know a lot of you might be pushing back. Everybody does it. I'm aware of it. They say we can do it, so it must be true. The biggest brokerages are doing it. It must be true. It's not. It's not an interpretation either. And as licensed mortgage professionals, hopefully all of you have read the CFPB laws on loan officer compensation. And if you've read the loan officer laws on compensation, you would know has nothing to do with interpretation. It's black and white. So again, I'm not going to beat that horse right now. But if you don't believe me, just read the loan officer laws on compensation. And I'm only telling you this because, one, a lot of people in our industry has been violating federal law for a very, very long time. And if you're working for a mortgage broker that is paying you different when you go borrower paid, they are stealing from you. It's not legal. All right, let's not beat up on them anymore at the moment. Let's beat up on the retail though, because retail does the same thing. They just do it differently and they use different semantics. So if you work for a retail company or retail mortgage company, mortgage banker, again, they don't have lender paid and they don't have borrower paid. They can simply move the price point if they get into a competitive situation. Okay. So let's say the loan officer's compensation, again, from a retail, the average compensation retail, let's say 150 basis points, typically net. Okay, typically net. So we got to take that into consideration. So they're at 150 basis points net. And if they get into a competitive situation and the branch or the company has to do concessions to meet a price points, then they're still going to get 150 basis points by law. Now, unfortunately, most of the competition, most of the mortgage bankers out there don't do that. They actually flip it from a self-gen lead, and you guys know, you're well aware of what I'm talking about if you work for a retail operation. They'll switch it from a self-gen lead to a branch lead, and on a branch lead, they technically can lower your compensation per the CFPB laws. but it never was a branch lead. It was self-gen. Yet they're still flipping that deal to a branch lead when you get into a competitive situation and need concessions because it lowers the income to the branch or company. And then they change your compensation. Not legal. Same law applies. It is not legal. You can't do it. So if you're working for a retail bank, and every time you get into a competitive situation, if your compensation changes, your company is stealing from you and committing a federal violation. I'm not naming competitors, but I would say it would be applicable to most. No comments on that one. I thought that would stir it up. So my guess is most of you are like, either Aaron has no idea what he's talking about, or holy smokes, I've been robbed. And most of you have been, because it's not legal.
So
The other
Aaron,
thing that's different. Yes. Somebody asked.
Yeah, real quick. So the question that popped up on your screen before was a poll that we launched. I'm going to end that poll now. 15 of our attendees answered that question there. 100% said that they were not netting more than 250 basis points. So to sum up everything that you were just talking about, essentially legally, we're able to pay them more.
Yeah, so that's always been the case. That's due to federal laws. Again, if you're working for a broker or you are a broker, the maximum compensation that you're going to receive, period, is going to be 275 basis points, and that's gross. That's a gross number. And there's an immense amount of expenses that will come out of that to keep a company going, regardless of the size, whether they're a one-man shop or a huge brokerage. It won't make any difference. There's a lot of expenses that are going to come out of that 275. How well you run your business, how much you pay your employees. I mean, there's all of these variables that are going to come into play that's obviously going to move that number. My point being is that having spoken to literally hundreds of loan officers that work for brokerages whose comp is, 220 is a very common thing that you hear. That's gross. And if you do simple math and you net out all the expenses that come out of that 220, typically the net result to the loan officer is going to be south of 150. And again, it will vary by company. It also vary by loan amount. So it may not be applicable to your situation, but I would say that if you take on average, the average loan officer that works for a brokerage is netting somewhere around the 140, 150 mark. What you might say is great because it may be more than you can get from a retail bank. And that could be true. A lot of retail banks, I think the average loan officer compensation nationwide right now is about 90 basis points and falling. And it's never going to go back up. So that it's very sad that, and it's the loan officers that have done this to themselves because they've allowed themselves to continuously get paid less and less and less and less. Most of the retail banks last year slashed compensation because they were lowering margins to chase interest rate to the grave. And as the business improves and gets better and the volumes go up, very few of them will actually raise loan officer compensation, even if the company margins are going up or the profitability starts to go up. And again, some vast differences. We really saw the extremes of this in 2022 when 99% of mortgage banks took massive, massive losses. And continue in Q1 of 2023. And not to brag, but kind of, Geneva Financial was profitable last year. We may have been one of the only, potentially the only mortgage banker that was profitable on originations last year and profitable in Q1 of 2023. I'm proud of that, but that really has a lot to do with not only, how I manage and lead the company, but also how the branch managers manage their branches. Understanding that it's not something to be proud of to do the most volume at the greatest losses. That's not good. But our industry seems at least in 2022, to celebrate that. I mean, they're still doing president's clubs for people that have lost the most money for their companies. It's beyond me, but that's neither here nor there, and I'll move on. So yeah, if you're working for a broker, you're not making, nobody's netting nobody in the industry is netting 250 basis points, with the exception of some of the people that work at Geneva Financial. I'll get to that in a minute. Brokers are better, cheaper. Nope. And again, I understand I didn't want to work for a retail operation either, because one, they're bloated, most of them bloated with management. You know, you have state managers and district managers and regional managers and SVPs and RVPs and everything under the sun. You got all these hands in the cookie jar, and for what? Waste. It's because a lot of people that work for mortgage companies at the executive level like to golf and not do anything, right? So they hire a bunch of people to do their job. I work, right? We don't have regionals, and I would never put a regional on top of another branch. That's absurd. If you're a branch manager, you should know how to manage. You shouldn't need another manager or 3 managers on top of you to teach you how to manage, okay? If you need regional managers and district managers, then maybe you shouldn't be a manager to begin with. And again, that even goes for a lot of branch managers. When I talk to loan officers, the first thing out of my mouth is, what's your branch manager do for you? And in most cases, it's zero. Not in all. There are some amazing branch managers out there. So don't misunderstand what I'm saying. And the same goes for branch managers when I say, hey, what's your regional doing for you? Nothing. Why do you think most regional managers are on their way out right now or currently unemployed? Because they're the first people to go once things get a little bit skinny. We've seen it. Now, let's take my word for it. It's happening right now. So I didn't want to work for a regional or a retail bank because they're just not going to pay me very much. One, they try to net so much more money. So back to what we try to net as a company. This is very profound in our industry. Is Geneva Financial, our model, I'm designed to try to make 50. I do not want to make 100. I don't want to make less than 50. We try to net 50. Okay. And those of you that work at retail operations are like, all my company's trying to net is 52. It's not true. And I know it's not true because we have data on this. And we have recent data on this. Now, again, in 2022, the average mortgage bank, the overwhelming majority of mortgage banks took a net loss. Bad management. Bad management. And even if they were lowering their rates intentionally so you could have the lowest rate to your consumer, what do you think is going to happen now? One, how many countless mortgage banks have gone out of business because that was unsustainable, right? And now all the other ones, I mean, United Wholesale Mortgage, those of you that are working with United Wholesale Mortgage, their rates aren't good. They're not good. But maybe they've never been that good. We'll get to that in a second. Yeah.
We got an attendee question asking, what does Geneva provide for the 50 basis points that we are taking from each deal?
Too much. Too much. One, the amount of return that we give the branches and the originators for the 50 basis points, the bigger 50 basis points I'm trying to earn is a lot. It's a lot. You get a tremendous amount of value off the amount I'm getting. And I'll get back to that in a minute. I'll explain the differences of what we do have to offer. But before I do that, let's go back to 2021, a more normal, I know still inflated volumes for the industry, but and this just came out, of course, the information's been out for some time, but you can see it in publicly traded companies. And Fannie and Freddie just put a report on this, but the average mortgage bank netted north of 200 basis points in 2021, netted north of 200 with all their bloated management and all their inefficiencies. They were netting over 200 basis points. And I think Guild, not to throw rocks, amazing company. I think Guild in the fourth quarter of 2021 netted like 260. In comparison, Geneva is much more efficient, not bloated, trying to net 50, netted just over 50 in 2021. So that allows me to pay so much. And that will give you some idea of the immense amount of money that we pay to the originators that none of my competition is able to do. and why we are able to do the things that we're able to do. So what do we offer with this? So, and again, for those of you that are working for a retail operation right now and run on a P&L, you run on a gross P&L. You like to brag about margins, that you have a 400 or 500 margin. Again, back to gross. Your margins are gross. And after they whack you for credit reports, payroll taxes, VOEs, VODs, per file fees. I mean, the technology fees, marketing fees, the amount of fees that you pay are immense. And so your 400 or 500 margins really is a relevant thing because you're spending so much money on expenses. Okay, it's all about what you net, has nothing to do with your gross margins. What do you net? So for Geneva Financial, not only are you getting a tremendous amount of sales support, so lacking in the industry. I do a lot of training on that. I come from a very extensive sales background where I actually teach people how to sell, right? How to build value, how to build rapport, how to create a consumer that is going to be less price sensitive, regardless of credit score or net worth, regardless of market, which is irrelevant. A lot of you guys think or ever have enough in your head that my market's really competitive. You have a problem already, because it's no more competitive than your neighbor's market. It's what you know. So we teach you how to get around those things. Our marketing is bar none the best in the industry. I would put our marketing department against any company's marketing department. We have a very, very robust marketing. I call it a marketing agency embedded inside the company where we market for the originators and the branch managers on a daily basis. It's not third-party purchase canned BS. We create the content, and the most important part of our content is designed to create relationships. So this is just a simple example of a vast difference between us and most of our competition. Is most of our competition of recent, maybe a few months ago, 2-1 buy downs, 3-2-1 buy downs. It was a talk of the town. You were posting it all over your Facebook and your social media, which is good. You need to be on social media. You have to be on social media. The vast majority of your consumers are on social media, but you know what? They don't care. They don't care about 2-1 buy downs. None of them. They don't care. And if you know anything about algorithms that the social media systems use, if you're posting 2-1 buy downs or, the difference between FHA and conventional is this, and nobody's looking at it, they're not because they don't care. It stops showing up on their feed. So you're putting a ton of marketing information out there to the public and nobody's looking. Nobody's even seeing it. And nobody cares about it. They don't. The only person who cares about a 2-1 buy down is the person you're already engaged with. It's not going to spark somebody to go, hey, maybe I should buy a house because XYZ mortgage company told me about this 2-1 buy down. It doesn't. Now, does it ever move the needle? Yes, of course, there's somebody that you might get, but the overwhelming majority of people don't care. So why James and his team is so brilliant is they put out content to build relationships with consumers and trust with consumers and engagement with consumers. And so when that customer does need a mortgage, which is only a few times in their life, we're front and center. They're seeing our information. They're hearting it. They're liking it. They're commenting on it. And they will remember who we are because we're constantly in front of them with content that they care about. The industry doesn't do that. We do. And maybe that's one of the biggest reasons in 2022 that our branch managers and loan officers did not have to chase rates to the grave. We did not lower margins. We did not do loans at a loss because maybe we just generated more customers that cared more about the relationship and our professionalism. Maybe. But it happens. And so I would say marketing has a lot to do with it. There's a technological piece. I don't like to sell technology too heavy. We have the latest and the greatest and the fastest and the most efficient and a lot of automation in our technology, but it's a cautionary tale. because I don't want to see my originators do what most originators are doing in our industry, and that's automating themselves out of a job. And they are. The biggest push for this industry right now is to get rid of originators. It's been their focus for a long time, not mine. Why? Because you're the most expensive part of the transaction, aside from technology, ironically. Great technology to improve your efficiency, but you should be forward, human forward. That's critical. Things that we also teach you. One, I've never seen a mobile application build rapport or overcome objections. So if you're technology forward, it's no wonder you're averaging 100 basis points a transaction. You've built no value to yourself. None. And if you've commoditized mortgages like Carvana has with cars, then you've made it a simple commodity. You haven't made it an important thing. And it is the single greatest liability that most people will ever have. You need to treat it as such. You need to treat it as a serious thing, a serious life event. And if you can do that, you can build a lot more value for yourself and earn what your value actually is. It was always amazing to me when things get tough, like it did in 2022, like it will continue even more so for the consumer in 2023, especially if we go into a recession. As things get tougher for the consumer and they need your help more, assuming you're a mortgage professional, why does your value go down? Why does your compensation go down? It shouldn't. It should be just the opposite. And if you can convey that to the consumer, you will earn more in times like 2022 and in times of 2023, even if we're under margin compression. These are some of the things that we teach you. Systems, technology, we have all that. But the biggest thing I think that, I don't want to say biggest because it actually puts a shade on the other things that were remarkably better than the competition at doing, is if I am as a company trying to make 50 basis points and we can pay so much more to the branch managers and loan officers, it allows them to do things that most in the industry can't. I'm giving them more capital to work with. And we give them such great autonomy that assuming that it's legal, they can do anything that they want with it. So the overwhelming majority of my branch managers are netting far more than 250 basis points. In 2022, in the first quarter of 2023, and historically over the course of 16 years. The average loan officer that works for Geneva Financial, I'm guessing 150, 175 basis points nets. Some are over 200. That's handled at the branch level, not at my level. Net. We don't deduct anything from that. We're not, if you work with an LOA, I'm not deducting it from your comp. This is net. I don't hit you for the payroll taxes. I'm not hitting you for credit reports, mobile application fees, the vast marketing that we do for you every single day, you don't pay for it. I'm trying to generate you more business. It doesn't make any sense for me to charge you. I need you to generate more business. I'm trying to help you generate more business. Why would I charge you for those things? I know it's counterintuitive to what most of the industry does. Okay, so when the next thing that happens when they hear things like that branch managers are netting 300 plus, which in many cases they are in 2022 and today, that your pricing must be really, really high. Well, pricing's in the eye of the beholder. And I'll say this over and over and over again, and I have for over 20 years, is that the most price sensitive person in any given transaction is you, the loan officer. True story. I know a lot of you are like, dude, I'm in a real competitive market. No, you're not. And it takes a long time to get you through that. I'm in 48 markets. I know that your market's not the most competitive. I know. Because every loan officer, every branch manager I talk to, regardless of where they're at, Alaska, Florida, Hawaii, it doesn't matter. Alabama, I'm in the most competitive market. The people here are really sophisticated. What? Because they have internet? The most sophisticated borrower is somebody that has internet and Google and can Google up mortgage rates. That's sophisticated. Okay, that's it. Everybody can find the lowest rate, and there's somebody out there that has a lower rate than you, period. But at the end of the day, it's about what you're willing to earn. What's your value? So this is a live one-on-one, face-to-face conversation I had with a mortgage broker on Monday. They send 100% of their business to United Wholesale Mortgage. Not throwing stones. I'm just giving you an example. And at every single price point and every scenario, I beat her. Every single one of them. But to understand how did I beat them, what I mean by that is at every single price point, if I match that price point, my price point generated more net income to the originator than United Wholesale Mortgage in every situation. And historically, that's always been true. I hope you're following along with that. The problem, again, goes back to whether or not you're willing to follow federal law, which most brokers are not. One, because they don't even know that they're in violation of the law most of the times. But again, it's a whole nother argument. The meaning is that if my originator is trying to net out 250 basis points, and they're up against a broker going to United Wholesale Mortgage borrower paid at 100 basis points, of course, the broker is going to have a lower rate to the consumer. They're cheaper in that sense only because the loan officer has less value. Is everybody following along with that? I hope you're following along with that. It's only because the loan officer on given transaction has been willing to work for far less than maybe my originator is. But it's the originator's choice or the branch's choice. I guess that can be said on both sides. But I don't have any loan officers that are willing to work for 100 basis points, nor should they. They offer a lot more value than 100 basis points. And I would say they shouldn't work for under 150, but that's a personal opinion, right? It's a personal opinion. I sure as hell wouldn't as an originator. The whole reason I started Geneva Financial. Go to a retail broker that was going to pay me, or a retail operation that's going to pay me 150 basis points. Pound sand. I would never work for 150 basis points. Not personally. Never, ever. As an originator, why? Because I'm worth more than that. It's all about what you think your worth is, and what you charge to the consumer is a direct reflection of your worth. A direct reflection of your worth. And if you, like a lot of brokers or bankers, even originators, say we all sell the same thing, that may be your first problem, because we do not. We do not sell the same thing. I do not sell the same thing as 99% of the originators that have ever been in this industry. I do not. And I like to think that my loan officers and branch managers are at that level too. And some of them are. The pricing comparison has to do with the earnings, the net earnings. And back to what I was saying, the most important things where people get very confused, and brokers, especially brokers, like to sell, we're the cheapest. We're the cheapest. We're the cheapest. It's not true. The interest rates that you offer, I can offer the same interest rate, and I will always, almost always, generate a higher net income to the originator in every situation. With that being said, doesn't mean we want to. Doesn't mean we want to. If we have to go up against a broker that's willing to make 50 basis points, walk. Why? Why would I walk? It's a personal opinion. They can compete for it. My branches can go that deep. So think about it this way. we're going up against XYZ mortgage company. The mortgage company, the loan officer is willing to work for 100 gross, 100 gross, right? That's getting you down to like 50, 60, maybe 70 net. That's absurd. I'd rather drive Uber. But let's just say, okay, that's all they think they're worth, and they're willing to do it for 50, 60, 70 net. So be it. If my loan officer really wants to do the same thing, they can, and they will beat you every single time. They will. But the vast difference is my loan officer will not make less money on that given transaction, because that would be illegal. If they had to drop the compensation or the charges to the consumer to net out 100, my loan officer's at 150 basis points, my loan officer's still going to get 150 basis points on that transaction by law. And it's the right thing to do. But it's the only legal way to do it anyway. Every single time. Now, if my loan officer's consistently giving away more money than we're paying them, obviously that's a bad financial deal. And that loan officer is not worth the 150 if they're only generating 100. And we'll have a conversation about their compensation on all loans going forward, but not the one-offs. It happens. Sometimes you got to go deep. And sometimes you're willing to go deep to save a relationship or look good in the eyes of a realtor that you're trying to win over. I'm not going to penalize the loan officer for doing that. One, it would be illegal. Two, it's not the right thing to do. And I don't steal from my employees like the vast amount of people do in this industry. Again, come full circle. If you're working for a brokerage and you go borrower paid and it changes your comp, illegal and theft. If you work for a retail operation and you give concessions, which is the same thing, is essentially accomplishing the same thing as going borrower paid, just using different semantics, and they change your compensation from a self-gen lead to a branch-generated lead, they're stealing from you. And it is illegal. We don't do that here. Questions?
Yep, want to get to a couple questions here. I will address this one real quick. We have an attendee asking about DPAs. We do carry Genoa. I believe we have the Maryland now, and I will check on the Virginia one. I'm going to drop my cell phone number in the chat, you guys. If you want to ask me any questions or have me follow up on something, I'm happy to do that for you. We'll drop that in there. We do have a ton of DPAs, hundreds across the nation via states and all the federal programs. We don't advertise it heavily because we do all that we can at the corporate level to try and keep our branches profitable, and those just don't math out that way. So we don't market them heavily, but we do carry all the ones that you guys are used to. We do have that. So Aaron, we've got a question here about the operations department. Attendee says, I don't want to chase docs. So how are the loan partners and processors paid?
All right, hold up real quick. Well, let me get to the DPAs real quick. Thank you for summing that up real quick for us, James. The Chernow and I think the Essex program actually pays enough to compensate the originator at a high level and have the branch not take a loss. But again, a critical difference between us and probably the entire industry is that if you do a DPA program, regardless of the DPA program, whether it's local or a national program, your compensation does not change. That too would be illegal. So you will get the pay as an originator, you'll get the paid exactly the same as on a DPA loan as you would on a Fannie Freddie or government loan. There's no change in compensation. Again, not legal. I know a lot of you believe there's some kind of carve out for DPAs. There's not. Just like if you happen to work for a retail channel and they do broker loans, if they pay you different on brokered loans than bank loans, illegal. You can't do it. You can't do it. And you haven't been able to do this since 2009. Okay, so this is a new regulation. The Federal Reserve law on loan officer compensation that came out in 2009, which was later rewritten by the CFPB, I believe in 2014, 13, they both stated the same thing. So you can't get paid different. We don't pay you different. We abide by the law, super compliant, and being extra compliant actually makes you more money as an originator. So it's another win for you. Back to operations. So if you're a loan officer and don't want to chase docs, this is a touchy subject for me. So I'm assuming that the question came from somebody that's very, very high producing and literally doesn't have the time to ask the borrowers for a bank statement or W-2, which usually takes only a few minutes to do. But if you are a high producing originator and you need a loan officer assistant or loan partner, then that's usually handled at the branch level. We have a lot of branches that actually have loan officer assistants, and that would be something that we can accommodate you for. Even if you are a low producing loan officer and feel the need not to want to collect W-2s, that can be accommodated. I don't necessarily think that's your best use of your time. If you're a new loan officer doing low production, you want a lot of engagement with your borrower. That builds, again, trust. It builds a friendship, rapport. It builds the ability for you to ask for referrals, to potentially get into the companies that you're working with. It's something that you shouldn't be avoiding. You should actually be involved with. The quick answer is yes, we can accommodate regardless of your production. And your comp doesn't go down. Doesn't go down.
And on a technology side, I can piggyback on that piece. A lot of branch managers that join us kind of change up their model a little bit based on all the support they get from our technology. Our mobile app, for example, is very easy to collect docs on. They're finding their transactions are getting moving a lot faster than previously. So they're kind of reassessing what support staff they need at the branch level. You have your processors at the corporate level and such. So it is a little bit different on that end. Okay, next question that we have is who covers the expenses of a branch? I've been in that branch and the company covered the overhead. I'm not sure what overhead they're referring to. If you want to drop any clarification on that in the Q&A while Aaron's answering that, I can chime in with that.
Yeah, that'd be important to know. I mean, again, I assume that it might be out there, but I literally talk to a half dozen people a day from coast to coast. I've been doing this for nearly 16 years. So we're talking about thousands in total. I've never come across a P&L model that works closer off of net margins that we do versus gross margins. The overwhelming majority of my competition will bury you in expenses. And again, a lot of times branch managers don't even realize they're paying the expenses that they're paying because they've line itemed. Well, one, there's so many line items. I'd say the average P&L for a branch of my competitors is multiple pages, maybe half dozen or even more pages. I talked to a large branch a couple months ago, and his P&L was like 25 pages. Our average P&L, regardless of branch size, is 1 to 2. That's it. Because we just don't bury you in expenses. And again, some people don't even know what they're paying, and they're not paying attention to it because those changes, those charges that your company are charging you also change. And sometimes it's a way to generate more money to the company. They're not legitimate.
And that Tony did clarify that it was a lease expense.
It was a what?
Lease for space.
Oh, yeah. I mean, our branches, any self-inflicted expense that our branches incur, like a lease, or if they want a chauffeur or a secretary, the branch is going to pay that. But I will tell you, there's a big difference too, is our branches that have their own processors, they pay for their processors, but Geneva pays the branch $4.95 per transaction to offset that expense. So usually branches that are doing, 10, 12 deals a month, it becomes net profit center for that branch. They actually make money, net income from having their own processor. And the branches that want it and have the ability to manage it have their own underwriters. Again, they take on the underwriting expense. I pay them $500 per file. That's usually going to net them positive income at about 15, 16 units a month. And so our branches, again, back to the autonomy, and depending on the size of the situation, a branch that's doing 15, 20 units a month, they potentially have their own underwriters, their own processors. They don't have to ask the company for a rush. They just tell their underwriter to move the files, right? It's their underwriter. And their turn times, even though this is absurd, but most of my branches that have their own underwriters, their turn times are 5 hours. Right? 5 hours. And so again, nobody needs 5-hour turn times. That's an absurd thing, but it sounds good. And it sounds good to the referral partners that you're trying to get, i.e. real estate agents, CPAs, so on and so forth, because they have an in-house underwriter that they can talk to if need be. It's great for your team. They like the flexibility. And from a recruiting standpoint, it's spectacular because, again, not only are we going to pay the loan officers more than anybody in the industry, and again, I've proven that for 16 years without failure, with a competitive rate and the greatest marketing, but we also got 5-hour turn times. So it's a nice cherry on top to help seal the deal.
Next question we have is, how do you support reverse mortgage loan officers?
Say that one more time.
How do you support reverse mortgage loan officers?
Reverse mortgages, that's like one of the only wholesale products that we have. One, because we don't do a lot of them as a company. I have like a handful of loan officers that do specialize on reverse. One of my longest employed loan officers has been with me since the inception of this company. He does only reverse. So I would say that we're good at it, but we don't have a big reverse center. So if somebody comes over to Geneva and does do reverse mortgages on a regular basis, they're going to want to have an understanding of how to do it. From my understanding, they're very simple to do. We also, because they're a wholesale product, we pay more than anybody in the industry on reverse mortgages. In most cases, and again, there's some variables, but I'm not like going to blindside you with something. We would typically pay the branch, assuming the loan officer's in the branch, 80% of whatever the wholesaler pays me. So on a reverse mortgage, the wholesaler is going to typically, again, depending on what you charge, will usually pick up between 600 and 1,000 basis points on a reverse mortgage, of which we'll pay 80% to the branch or originator. But you got to know what you're doing. You got to know what you're doing. And again,
okay, next question. The question is, the branch that I'm with has a team of loan partners and processors who collect and upload docs, act as a liaison between the buyer and underwriter, collecting conditions and things like that. Is the loan originator expected to collect conditions? I always get stubs, W-2, and bank statements up front. I'm referring more to the underwriting conditions.
Okay, and again, this is more handled at the branch level. So if you're a loan officer that works for a branch versus being a branch manager, if you're a branch manager, you can set your systems however you want to set them, however you think it's best to run. The vast majority of the branches, including corporate in general, is what we want the originator to do is to submit the initial file to processing with at least enough documentation to know that we can get a credit decision. One, as an originator, if you're issuing a pre-approval, you have to have seen income assets, the minimum, right? You have to have seen it, or you got all kinds of other problems. So assuming that you have the minimum documentation that goes into processing, processor is going to review. In most cases, they're going to order appraisal, title, VOEs, VODs, submit it to underwriting, comes out of underwriting approval with conditions, and the processor is going to clear those conditions with the consumer. If your branch is working with LOAs, it might be the processor and or the loan officer assistant that will collect those conditions from the consumer. That's how I recommend people do it. I think it's in the best time usage of your originators to spend most of their time upfront selling originating files and not following trailing docs. But you do need to know what the original docs are, the initial docs, to even give them a pre-qualification. I would say that's a a rational thing to do in any transaction. And then again, your approval with conditions should only come back with a handful of conditions. So if you're getting approval with conditions and there are 3 pages, you as an originator have a problem. And we can help you with that. That should not be the normal situation. You should submit it, come back, updated pay stub, maybe updated bank statement, a couple of things that you missed, maybe the processor, the LOAs are going to get that for you. If you do your job as an originator, you should submit that file to processing and walk. I don't largely originate anymore. I did a bunch in 2020 just because it was too easy not to. I could take it. I teach people how to do this. So what I'm saying right now, you might call BS on it. No, it's absolutely true. I teach people how to do this. But as an originator, I can take a 1003 in 5 minutes, 10 minutes. I'm going to spend most of my time on the phone building rapport, building the trust, so I don't get shopped, so I don't get pricing, objections. And then I send out the disclosures to my consumer, a list of initial documentation I need. Once that comes back in, I don't even quote rates. I don't quote rates over the phone. I send them the disclosure, sign it, get it back to me, send me your W-2s. And they do. They do, because I don't have pricing objections. I just don't get them as an originator. So once I get the initial documentation and the signed disclosures, electronically signed disclosures back, I submit it to processing. I don't even know if the loan's funded. I'm out. I don't chase my processor. What's going on? I don't do any of that. The realtor calls me, what's going on with the transaction? I send them to my processor. They know I don't. I'm busy doing productive things. I teach this. A lot of loan officers have a hard time letting go, even if they have the support staff, a processor, an underwriter, or an LOA. And maybe that's because you've just worked with, subpar support staff. But with our support staff, as long as you're submitting accurate files with that, accurate information, you should be able to submit it to processing and stay out. Every time you call your processor, they stop processing. Right? All right. More questions.
Do we charge for rescores?
What?
Do we charge for rescores?
Do we charge for rescores? Not to the branches. It will be charged to the consumer if the loan closes.
I think we covered all the questions in the chat. Does anyone else have any questions? Drop those in the Q&A. Is there anything else you wanted to cover, Aaron?
Yeah, I'll leave it on one thing and again, I don't know who the people are on this call. I don't know if you're brokers, your loan officers, your branch managers. I don't know. So I try to cover as many points as I can, assuming I've got a blended group of people. The greatest challenge that I have, I spent a tremendous amount of time trying to change people's lives, trying to save people's lives, trying to change their career, giving them an opportunity to earn more money than they've ever realized. And we've been able to do that for 16 years, but it does come with challenges. In most markets, once they understand the vast differences between us and everybody, I get the too good to be true. It's not real. And then I have a believability issue, and which is a good problem to have, but it's still a problem. So once I get people to understand it, right? And once they do understand that the light goes on and they understand the difference between net and gross, they're like, how do you pay that much? Right? How do you have that price point and pay as much as you do? Because they simply don't realize how much money their companies make in most markets. Throw 2022 out of the window, because 99% of the people on this call, their company didn't make money last year. They lost money. But in most markets, your companies are making way more money than you think, way more money. And I don't fault them for doing that. Guild made 260 basis points net in fourth quarter 2021. I don't fault them for that. That's their business model. Kudos to them. But that's not what I do. That's not what I've ever done. And when I'm talking to, especially with branch managers, because I spend most of my time with branch managers, the hardest part is getting them to understand the vast differences between the net and the gross. Because I'm up against branch managers, and the overwhelming majority of branch managers in this industry with my competitors will have branch margins 400 or north of 400. Okay. And that's, I know, okay, I'm not casting stones. But their 400 margin nets a fraction of the income my 300 margin does. And so it becomes a big issue. It becomes a big issue because they're like, Aaron, why would I come to Geneva Financial? I'm at 400, you're at 300. Well, my 300 will double your income. And in most cases, historically, compared to any one of my competitors that run on a P&L, I typically can double the income of the branch manager while increasing the loan officer's comp, meeting the same price point. And brokers, it's a whole different game. Because I'm going to smash them in comp every single time. But the challenge is a lot of brokers, super price sensitive, and they don't want to earn what we typically earn. Doesn't mean the rates are any better. They're not. But they just don't want to earn. And if anything that, back to the 50 basis points, what do? I would say the biggest thing somebody can take from me in this company, aside from the marketing, which is pretty spectacular, is we'll just teach you to increase your self-value. And when you can increase your self-value, you have more confidence. And regardless of where you live or do loans, you'll be able to earn more. Period. You can pick what you want to earn, but you'll be able to earn more. And hopefully everyone that's listening to me is in this business to earn. Because it's a very tough business if you're not making money. If you guys don't have any other questions, I appreciate you doing this. We're going to hope. Go ahead, James.
We do have another question, if you have time, Aaron.
I always have time.
What out-of-pocket expenses do MLOs have?
None.
Only self-inflicted, yeah?
But I mean, it's not even out of pocket. You shouldn't be paying things out of pocket. It should be expense. I mean, again, the semantics. If you pay for something that's business and it's an IRS deductible thing, you can run it. You can expense it back to the company or to the branch as what you should be doing. Right? You take a realtor out for coffee. You're not going to expense reimburse that. It's not efficient. And hopefully you've got the $5 to buy the latte. Okay. It's not a big deal. But if you're doing an event, if you're throwing a big event for realtors or referral partners or whatever it is, that's all reimbursed. You're going to run that through the branch. It's not going to be an out-of-pocket expense. And any reoccurring expenses, Geneva Financial should just be paying for you on a monthly basis.
Very good. Typical time and process for onboarding.
Typical time and process, that it's 100% dependent upon how much volume you're doing. We have got an amazing transition team. I've got an entire team that's designed just to help transition people. Why? Because we're growing. I mean, we actually have net originator growth in 2022. I don't know if any other company had net originator growth. We've been bringing on a lot of originators and branch managers, so I've had to be able to accommodate that kind of a growth without having people miss the mark. I know a lot of people dread transition, not here. My biggest problem with transition is that they don't want to leave it. That's a true story. They want to stay in transition because we're so consumer oriented. We're so customer friendly. We hold your hand. We're very, very, very fast and accommodating that they don't want to leave because it's superior service to what they're used to. But we will graduate you out of transition. I always tell people, do not move your license to Geneva Financial until you get paid on every single transaction that's in your system, in your current system, and absolutely never move a live loan from your current employer to me. That's theft. But we have a process that will allow you to start getting integrated into Geneva Financial day one. You'll never skip a beat as far as income. And the transition period for an individual loan officer is usually about 2 weeks. For a branch, maybe about a month. But again, you're never during that time going to be at loss of income, earnings, or the ability to generate more clients. It also touches on one other thing. We pay weekly. We pay every single Friday to operations and originators. So that's also kind of nice. I don't pay the originators when we sell the loan. I pay the originators based on when it actually funds the title.
And the last question, if after this call we decide to join, what is the next step?
James, tell them. I mean, I don't know if everybody has access. Where my, I mean, anybody can find me and reach out to me directly. If you come across a cell phone number, that's me. That's my cell phone. Maybe I shouldn't open this up, be so public about it. But when you're an employee of Geneva Financial, every single employee at the company has my cell phone, and I encourage them to reach out to me. Again, I don't have 10 district managers for you to talk to. But as far as being able to apply, if you want information, you can reach out to us. But James, why don't you tell them the best site or what way they should go?
Yep. If you received an invitation to this call via email, that is an individual that has you on their talent radar. You can reply to that email and they will get you moving through the process. If you've already been talking to a recruiter, make sure you connect back with them. If you are not connected with anyone, then you're going to shoot me an email. I'm going to drop my email in the chat there, jamesp@genevafy.com, and I'm going to get you connected with somebody. And they're going to have a discussion with you on several different items, like, if you're going to run your own branch, if you're going to go into a branch, what market. They're going to get with Aaron on any questions that he may need to answer for you. So we'll get you through that process, but shoot me an email and I will get you in the correct hands, depending on how that conversation goes.
For any of you guys, just top us off to know what Geneva is. I mean, we're in 48 states. We have roughly 700 employees, roughly. We have every program under the sun imaginable. And again, we feel by design much, much smaller than we are. That's what I want. I want more of a small family feel, regardless of the size of the company. We have a pick up the phone mentality too. I'm totally opposed to bureaucracy and endless email chains. So if you need something, if you need help on a particular file, you need help with somebody in our system, pick up the phone. Pick up the phone and call them. That's what we're here for. That's what we want. It's more efficient, and let's get stuff done.
Great notes it ended on. Thank you all for being here. Today we'll be doing this again next month, and we try and vary the topic each month. Next month, Aaron, I think we're going to focus on branch and originator growth, both on the recruiting and repeat business side. So we'll touch on that next month. Depending on Aaron's schedule, we'll get those invitations out as soon as we can. Thank you all for being on, and we'll send out a recording as well.
Thank you.
Thank you, Aaron.